Girish Ahuja is a very challenging task. And please appreciate my position here. And it'll be very difficult to live up to the expectations of the audience when they are willing to listen to a speaker like Dr. Girish Ahuja. I will tell you a small story on the situation of a substitute speaker. We all have heard of the famous scientist called Einstein. Now, when Einstein developed a new formula, a new phenomena, he used to go to various places to deliver his lecture and explain that concept which he had developed. When he used to visit various places, his driver used to drive him to the various places, and the driver was a very experienced person. It was warm that days. Those days it was a little warm. So Einstein sir told him that why do you wait in the sun? Come and sit in the hall, and you can listen to whatever is going on also. So the driver used to listen to Mr. Einstein. When he had listened to him for 15-20 times, so the driver told him, "Sir, आप क्या बोलते हो? I can also make that speech. अब तो मुझे भी याद है." So one day when Einstein sir was a little tired, he told the driver, "Okay, I will sit in the hall at the back today, and you wear my coat and go deliver the lecture." So the driver went and delivered the lecture, and because he was intelligent, he had heard the lecture for 20 times, he could deliver the lecture very well. Now came the time for question answers. Normal question answers he could answer, but when certain difficult questions started pouring in, it became very difficult for him to address those questions. He was wise enough. He said, "See, your questions are very simple. I will ask my driver to come here and explain them." So then he called upon Mr. Einstein, who was sitting at the back. Mr. Einstein came to the stage and started answering those questions. So friends, what the meaning of the story today is that I am in the position of the driver of Mr. Einstein. Whatever I have learned from Dr. Girish Ahuja, I'll be able to present that. Unfortunately, our Einstein Sahib is not here with us today, so we will have to manage it ourselves. Whatever question answers, whatever explanation is required, we will try to answer those amongst ourselves only. With that background, friends, the finance bill was presented by the FM this year. It was presented in the background of what was said is to lay the foundation of the next 25 years. It was described as the Amrit Kal. Amrit Kal means the travel from India at 75 to India at 100. Presently, in 2022, we have completed 75 years of independence. In 47, we'll be completing 100 years. So what is the path for the economy in the next 25 years? And what is the roadmap to be developed? I think the finance minister has tried to lay down that in this budget. So that was the vision of the budget. Now coming to the topic on hand of the amendments in the direct taxes. There are about 84 amendments which have been made in this budget. Many of them are small corrections in the drafting errors. Some provisions have become redundant, so they have been removed. The major amendments that we will discuss today, we can classify them into 2-3 categories. Some of them we will find are primarily to avoid litigation. Wherever there were disputes on certain points, we have tried to clarify them by bringing in the provision in the law so that henceforth the litigation comes to an end. Secondly, we have tried to correct certain drafting errors which were made in the last 2-3 years while drafting the new provisions. So we have brought those amendments in order to check the drafting errors. And thirdly, the finance minister had tried to plug the loopholes which were promoting tax evasion. So in order to check tax evasion, we'll find that there are certain provisions which have been brought in this act. If I start with the sections, I will go section wise and discuss the amendments which have been made. Firstly, we come to section 2, which deals with the definitions under the Income Tax Act. There are two amendments there. First is a little correction in the definition of the term slum sale. Slum sale was defined under section 242C. Last year, in the budget 2021, there was a variety of changes made regarding taxability of slum sale. We shifted the concept from the narrow concept of a sale to transfer by any means. So therefore, if an undertaking is transferred by any means, sale could be one of them, it would be covered under section 50B. And we also changed the method of computing the sale consideration. Now, when we were drafting the definition of the term slum sale, although at many places it was said transfer by any means, but at the end they still mentioned the term sale. That was not the legislative intent, so this amendment has been made just to correct that error. So now the definition of the term slum sale will include transfer of an undertaking by any means. Friends, the second most important definition which has been brought in this budget is section 247A, which defines the term virtual digital asset. This has been brought in primarily to tax commonly known virtually digital assets, or what we commonly understand as cryptocurrency. In cryptocurrencies or virtual digital assets, there has been a lot of speculation in the recent time as to what should be the taxability of this and what is the legal framework. In fact, we do not have any legal framework for these digital assets. At the same time, we see a spurge in the activities of cryptocurrencies. Even newspapers are filled with ads from exchanges which are dealing with cryptocurrencies, and we find a lot of people are actually dealing in with them. But there was no clear-cut directions from the government as to whether these transactions are legal, whether they are lawful, they are unlawful, whether they are taxable, not taxable, even that was not clear. What is the rate of tax to be applied, whether this is capital gain, whether this is business income, there was no clarity on this issue. In this budget, they have just made an attempt to introduce the concept of taxability of these assets. Nothing more. The finance minister was very clear. We are not saying that by introduction of this provision, we have legalized the dealings in virtual assets. So what we have tried to do in this budget is just tried to introduce the taxability. How have we done that? We have given the definition of the term what is a virtual digital asset. The definition itself is very controversial, very difficult definition to understand. It says virtual digital asset means any information, code number, token generated through cryptographic means, exchanged with or without consideration, with the promise or representation of having inherent value. It includes non-fungible token or any token of a similar nature, or any other digital asset as the central government may notify. What we make out of this definition, it is very hard to comprehend. This definition has been borrowed from some other legislation. The government is candid enough to admit that this is a very broad definition given by them. They are open to suggestions. If anyone has any suggestions, they are welcome to include that they are willing to accept those suggestions and incorporate that in the definition also. Primarily, which virtual digital assets do not include any Indian or foreign currency. So therefore, cryptocurrencies are not being recognized as a currency. Can we classify them as foreign currency? That also is a matter of debate at present. I think there is only one country in the world, I'm forgetting that name, El Aldo, something like that, where they have accepted cryptocurrency as a foreign currency. There it is being accepted as a mode of transaction also. So there could be a debate that it is a foreign currency because it is accepted in certain countries. But yes, we still have to wait and see what will be the fate of that. As I said, to tax these virtual digital assets, the government has introduced a new section 115 BBH. Under this section, it is laid down that any profits arising on the transactions of virtual digital assets shall be taxable at a flat rate of 30%. While computing this income, no deduction is to be allowed for any expenses excepting the cost of that asset. Now here again there is a lot of confusion as to what is the cost. Supposing I buy an asset, I buy certain cryptocurrency, then I have to spend some money on mining of the assets. Would that mining cost also be a part of the cost or not? I do not know. Or whether it be treated as a cost of improvement, we have to wait and watch. But tax will be 30% on the total transaction value minus the cost. You cannot adjust any type of losses against this income. So if I have losses from trading in shares, that cannot be adjusted against this. The question that again arises is, can I adjust losses from one type of virtual digital asset against income from another type of digital asset? Right? Even in cryptocurrencies, we have different types of currencies which are floating. We have bitcoins, we have litcoins, etc. So can the loss from one of these assets be adjusted against the income from a similar asset? That also is unclear. Losses from these virtual digital assets are not allowed to be carried forward also. So what we have tried to do here is we have just imposed a tax of 30%, just like it is imposed on other activities like gambling, lotteries, etc., without adjustment of any losses, flat rate of 30%. Another confusion that is arising in this provision is, under which head will I tax this income? Will this be, say there could be only two possible, or rather three possibilities. It could be taxed as business income, or is it capital gains, or is it income from other sources? There is no clarity in the law at present. We have just given the rate of tax. If it was to be taxed as a capital asset, we should have defined what is long term, what is short term, whether this will be treated, when will this be treated as long term, when it is short term, what is the period of holding. We have not made any such attempt. We have not included this in the definition of the term capital asset. So therefore, I do not think the intention is to tax it as a capital. So the only alternative left is to tax it as, just like we tax incomes under section 68, 69, etc., should be taxed as income from other sources, and the flat rate of 30% should be levied. Along with section 115 BBH, we have also amended section 56 to 10 to cover those transactions where any virtual digital asset is transferred from one person to another without consideration. As you know, 56.2.10 covers all cases of gifts where a person receives any sum of money, any immovable property, or any movable property without consideration or for inadequate consideration, and the value exceeds 50,000 rupees, it is considered as the income of the recipient. Under that clause, we have put this also. Now, virtual digital assets could not be sum of money. They are not immovable property, so they are to be covered as movable assets. The definition of this term of assets was given in 56(2)(7), where we had included assets like jewelry, bullion, paintings, sculptures, work of any art. All these were included in the term asset. What we have done is under 56(2)(10), we have just amended that definition and added the term virtual digital assets. So virtual digital assets will also now form part of the assets. And if a person receives virtual digital assets without consideration, value exceeding 50,000 rupees, that will be deemed to be the income of the recipient. All of these provisions of 56(2)(10) will apply here also, meaning thereby that if a gift is given to a relative, it will still not be taxable, because 56(2)(10) does not include gifts to relatives. That is excluded. Gifts on the occasion of marriage have been excluded. So those exclusions will still apply. So this was the amendment in 56(2)(10). One more amendment we have made is we have introduced 194S to provide for TDS in case of these virtual digital assets. Here a liability has been cast upon the person making the payment to deduct tax at the rate of 1% on the value of the transaction. This is primarily to ensure that these transactions are reported so that the government gets knowledge about them. These will be reflected in Form 26AS so that it becomes easier to tax them. However, again, there are a lot of questions which need to be answered. This TDS is first of all applicable only when the payment is made to a resident. Now here in most cases, we will find that payments are being made by certain exchanges which are located outside India. Some exchanges may be there in India which are definitely not being regulated, although they are insisting on KYC of the recipients, but still those exchanges by themselves are not being regulated. We have WazirX and there are certain other exchanges which are operating. So if the payment is made through the exchange is required to deduct the tax. Again, the problems will arise, where is this asset located? Many people have these assets in their wallets. There are various types of wallets which are being operated. These wallets may be located in India, may be located outside India. We are not sure about how to determine their location also. The servers of many of the exchanges may be located outside India. So these are some of the questions which are yet open for discussion, and I think once we have introduced this concept, these questions will keep cropping up and we will keep trying to find answers to them. At present, what we have done is, as I told you, let me summarize. We have introduced the definition of the term virtual digital asset. We have introduced 115BBH to provide for a tax of 30%. We have amended 56(2)(10) to include these transactions, and we have imposed a liability of TDS of 1% by introducing 194S. So these were the provisions regarding the virtual digital assets which have been introduced in this budget. Then friends, let me come to certain amendments which have been made mostly concerning business income. First amendment in section 14A. 14A, as we are aware, talks about disallowance of expenditure incurred to earn an exempt income. 14A says that if an assessee has incurred any expenditure in relation to an income which is exempt from tax, that expenditure is to be disallowed. We also have Rule 8D, which provides for how to compute that disallowance. Logical provision that if the income is being exempt, why should we allow the expenses against that? However, there were a lot of Judicial judgments, including the celebrated case of Chem Invest, where the courts held that if during a year the assessee has not earned any exempt income, you cannot apply Section 14. Meaning thereby that even if the assessee has incurred expenditure, but if he has not earned any income during the year, 14A becomes inapplicable. That was not the intent of the legislature. We had certain circulars, we had certain court decisions where the issue was still being litigated. So therefore, in order to put an end to that litigation, 14A has been amended, of course amended in favor of the department. Henceforth, any expenditure to earn a exempt income will be disallowed whether the exempt income has been earned during the year or not. That means even if there is no exempt income during the year, we will still apply the provisions of Section 14A. Then we have an amendment under the Section 17(2), which deals with perquisites. These are 2-3 amendments. I'll club them together. These amendments have been made in order to provide relief in case of COVID treatment. Now, during the last 2 years, we have gone through this COVID pandemic where a lot of people were ill. They had to incur a lot of expenditure on treatment of COVID, either at home or they needed to be hospitalized. In June, we had a press notification from the government declaring that intention that we will not tax this benefit provided by the employer. So therefore, we have that in the form of a legislation now. Under Section 17(2), the proviso says that if the employer incurs any expenditure or reimburses any expenditure on the treatment of the COVID of any employee or any member of family of the employee, that will not be considered as a taxable purpose. So whatever amount has been incurred by the employer on treatment of the employee or his family members, that will not be treated as taxable perquisite. Whatever be the amount, there is no limit prescribed here. Whether the treatment is at home or the treatment is in a hospital, both are covered here. Correspondingly, again a new provision has been introduced in Section 56(2)(10), because in many cases this expenditure on COVID treatment may not have been met by the employer. Many other voluntary organizations were coming forward and providing this facility to the employees. To the employees or to other persons also who may not even be in employment. So there also a provision has been made that if any person provides that facility or reimburses the expenditure in respect of medical treatment of COVID of any person, that will not be treated as a gift. It will not be taxable under 56(2)(10). In the case of the death of a person due to COVID, compensation was being paid to them through various organizations. So here also, whatever compensation is paid to the members of the family of the deceased person who has died because of COVID, if that compensation is paid by the employer, it is exempt without any limit. Without any limit, it is exempt. If it is paid by any other person, any other organization, compensation is paid to the family of the deceased, it is exempt up to rupees 10 lakh. Accumulated exemption of rupees 10 lakhs will be provided that this amount is received within 6 months of the death of that person. Therefore, these provisions have been inserted to provide relief for treatment or for compensation in case of COVID, either treatment or in case of death due to COVID. The next provision, the amendment is in Section 40A(2)(i), 40A(ii). This section deals with 40A section, we know, deals with primarily those expenses which are not to be allowed as deduction. And 48 2I specifically deals with any taxes paid in relation to the income of a person will not be allowed as a deduction. Therefore, the income tax that is paid will not be allowed as deduction, primarily because the taxes that are paid are not an expenditure to earn the income. They are an appropriation of the profit. The dispute was regarding what is the treatment of surcharge and cess that is paid. Is that also income tax? We had two judgments from the High Courts, one at Jaipur High Court, the other was at, I think, Mumbai High Court, where it was said that surcharge and cess do not fall in the category of taxes. They are not on the same footing as a tax. So therefore, following those two decisions, people started claiming this as an allowable deduction. Now, the government analyzed those two judgments, also analyzed some of the Supreme Court judgments which are already there, and then we came to a conclusion that surcharge and cess is also in the nature of a tax. Therefore, we amended section 48 2I to clarify that tax shall include surcharge and cess. Therefore, these will also not be allowed as a deduction. Because this is a clarificatory amendment, it has been made retrospectively effective from assessment year 2005-6. That is the year when the cess etc. were levied. So therefore, from that year itself, it has been clarified that cess and surcharge will be treated on the same footing as tax and therefore will not be allowed as a deduction. Two more small amendments in the head of business income. One under explanation to section 37(1). 37(1) provides, 37(1) explanation to 37(1) provides that any expenditure which is in the nature of a penalty, which is illegal in nature, unlawful, unethical, will not be allowed as a deduction. So all illegal expenses like bribes, etc., are disallowed. Penalty paid for contravention of any law will not be allowed as a deduction. Again, certain controversies arose. One was majorly regarding medical companies into manufacturing of medicines. Earlier, these companies used to give a lot of benefits to the doctors to encourage the promotion of their products. The doctors were receiving foreign tours, television sets, cash incentives just to promote the medicines of a particular company. The medical council issued a circular saying that these are unethical practices, should not be encouraged. The board, the CBDT, also took cognizance of these provisions and they also clarified that any freebies to the doctors, medical practitioners will not be allowable as a deduction. Then the controversy arose, what would be the treatment where the medical companies, these medicine companies, give benefits to the hospitals? Rather than the doctors, benefits are now being given to the hospitals. The medical council does not regulate the hospital. So therefore, these companies would claim that these are not covered by the circular of the medical council nor covered by the CBDT circular. So they used to claim this as a deduction. There was another controversy that if the payments are being made outside India, then whether they are legal or not does not affect the allowability of those deductions. So now, in order to put all these controversies at rest, we have amended that explanation to clarify that all payments which are illegal in nature, which are unethical, whether made in India or abroad, will not be allowed as a deduction. Penalties will not be allowed as a deduction. Further, any compounding fees paid to compound an offence will also not be allowed as a deduction. So therefore, to my mind, even the late fees, even the fees that we pay to the registrar of companies for compounding of offences, the fees that is paid for compounding of prosecution under Income Tax Act, or that matter any other act, all those will be disallowed under the now provisions of the explanation to section 37(1). Next amendment, section 43B. 43B, as we are aware, provides that certain expenses will be allowed as a deduction only on payment basis. So although the assessee might be following the accrual system of accounting, but some expenses like payment of any taxes, cess which are due to the government, any PF, ESI which is the employer's contribution to these schemes, the bonus to employees, payment to railways, these are all covered under section 43B. These will be allowed only on payment basis. Another payment covered in this section was any interest payment to banks and financial institutions. So large number of undertakings, large number of assessees were claiming interest as a deduction without actually paying that interest. They were neither repaying the loan nor paying the interest, but still claiming interest as a deduction on accrual basis. So that was also covered under section 43B. Again, we had some case laws, some assessees where the interest had accumulated over some years. Instead of paying that interest, the assessee converted that into debentures and therefore deferred the liability to pay that amount. So these are debentures issued, let us say, for a period of 5 years, for a period of 10 years. So you defer that payment. However, they were claiming the deduction on account of interest on the argument that we have discharged our liability to pay the interest. Now we no longer have to pay the interest. We will pay the amount of the debenture as and when it falls due. So the question was, can this be taken as payment of the interest? It has been clarified by this amendment in section 43B that conversion of interest liability into debentures or any other form of deferred payment will not be treated as payment. Therefore, deduction under 43B will not be allowed. So as I told you that all these amendments have been made primarily to see that wherever we had conflicting judgments, wherever the position of law was not clear, it has been clarified by amending these provisions. Next major amendment that I would like to discuss is in section 68. 68 deals with undisclosed income and says that where any sum is found credited in the books of accounts of an assessee for which either no explanation is offered or the explanation offered by him is not found to be acceptable, it shall be deemed to be the undisclosed income of the assessee. And this is taxed under section 115 BBE at a flat rate of 60% plus surcharge of 25% plus cess of 4%, leading to an overall tax of about 78%. How do I establish the genuineness of this transaction? How do I establish that this is a genuine transaction? There are 3 ingredients which have been laid down. I have to establish the genuineness of the transaction. I have to establish the identity of that party, from where I have got the money, and I have to establish the capacity of that party, that party has the capacity to give that amount to me. So these were 3 ingredients which have been laid down. Then we inserted a proviso to section 68 which says that in case of a closely held company, if that company receives any share money, any share application money, any share premium, or any amount of such nature, then that amount shall be treated as explained only when the assessee explains the source of that money and further also explains the source of the source. That means if a company X, closely held company X, receives any amount from, let us say, A, I have to establish that I have received the money from A, I have to establish his source, and I have to establish from where did A get the money. So I have not only to explain where I got the money, I have to explain further where he got the money from. That is called explaining the source of the source. This was presently applicable only in case of share money. We have expanded that proviso to cover cases of unsecured loans and advances also. So if a closely held company receives any share money, receives any loans, receives any advances, it will have to establish not only the source of that income, source of that amount, it will also have to establish the source of the source. That is as regards 68. Then we have two amendments in section 79. Firstly, an amendment to facilitate strategic disinvestment of public sector company. Section 79, as we are aware, is applicable to closely held companies regarding carry forward of the losses. It says that if a closely held company wishes to carry forward the losses, such carry forward will be allowed only if at least 51% of the shareholders continue to hold the shares on the last day of the previous year in which you want to set off the loss. So if there is a change of more than 51% shareholding, that loss cannot be carried forward. Now, in case of strategic disinvestment of public sector companies, many of which may be in the form of private limited companies, we have now amended this provision to say that if the public sector company continues to hold 50% of the shares of the original company through any of its subsidiary, one or more subsidiaries, then provisions of section 79 will not apply. So this is a benefit only for the disinvestment of public sector company. 79A, a new section has been inserted, again for prevention of evasion of tax. Now, see, whenever a search or a survey operation is done, certain undisclosed income, undisclosed investments, undisclosed stock, undisclosed bullion, jewelry, etc. is found. Now, these are taxed under specific provisions of section 68, 69, 69A, 69B, etc. And these are taxed at a special rate of, as I just told you, 60% plus surcharge. Now, many assessees tried to adjust their current year or their brought forward business losses against this undisclosed income. They would take a plea that this undisclosed income has also been generated through the carrying on my business. So this is also business income. So please adjust my brought forward losses or my current year losses against this undisclosed income. That was not the intent of the legislation. They wanted to tax all this undisclosed income at special rates of tax without any benefit. So therefore, we have inserted this section 79A to clarify this position that no loss, no depreciation, whether of current year or brought forward, will be allowed against the undisclosed income found during the course of a search or survey. That position has also been clarified. Now coming to the amendments in the deductions from gross total income. There are three amendments which have been brought in this regard: Section 80 CCD, Section 80 DD, and 80 IAC. 80 CCD provides for a deduction in respect of employer's contribution to the National Pension Scheme. Generally, the employer's contribution to the NPS of the employee is allowed as a deduction up to 10% of the salary of the employee. The employer's contribution is allowed as a deduction up to 10% under Section 80C. In case of government employees, the contribution was raised from 10% to 14%. Consequently, we amended 80 CCD to provide that in case of central government employees, deduction shall be allowed to the extent of 14% of the employee's contribution. This amendment was only with regard to central government employees. State government employees were still getting deduction only up to 10%. So now that benefit has been extended to state government employees also. So in those cases also, the employer's contribution to NPS will be deductible up to 14% of the salary. Next amendment in Section 80 DD. 80 DD provides for a deduction of 75,000 rupees or 1 lakh rupee to an assessee who has to incur expenditure for the maintenance or rehabilitation of a dependent relative. So if there is a dependent relative who is handicapped and the assessee has to incur any expenditure to maintain that person, to rehabilitate that person, then he is eligible to claim a deduction of 75,000 or 1 lakh rupee if the disability is a severe disability. The assessee may be either incurring expenditure, or there is also a provision that he might be paying some amount towards an insurance policy on the life of that person, that is the parent or the guardian who is maintaining that handicapped person, to ensure that in case this parent or the guardian expires, dies, then the handicapped gets a certain amount from the insurance company, so that his maintenance expenditure can still be taken care of. Now, in one of the judgments of the Supreme Court, Justice A.K. Sikri observed that there might be certain circumstances where the handicapped person may require the money even during the lifetime of his parents or during the lifetime of the guardian. If the guardian himself becomes disabled, is not able to take care, then where does the dependent go? So they had advised the government to make a suitable provision, which the government has made in this budget. Now this provision says that even if the insurance amount is received during the lifetime of the person, the parent or the guardian, provided he has attained the age of 60 years, that also will be exempt under 80 DD. For eligible startups. Eligible startups can claim a deduction of 100% of their profits for 3 consecutive years, provided they commence business during the period 2006 to 31st March 22. So the outer limit was 31st March 22. Because of the pandemic, certain organizations were not able to establish the business by this time, so 1 year extension has been granted to them. So now they can commence the business till 23. Besides all other conditions which have to be satisfied to claim this deduction under 80IC. Amendments regarding charitable trusts, there are plenty of them. I'll discuss them at the end. For new manufacturing companies, special provision under Section 115 BAB. 2 years back, we had reduced the rates of corporate tax. In some cases, the tax was 22% if the companies wanted to forego certain deductions, allowances, etc. And for new manufacturing companies, the rate of tax was brought down to as low as 15%, provided, of course, they do not claim any other deductions. And one of the major conditions was that they must commence production latest by 31st of March 23. Right? So besides all other conditions, the date of commencement of production should be any time before 31st March 23. This again has been extended by one more year. Again, because of the pandemic situation, these companies, certain companies which are into manufacturing, setting up their new plant and machineries, huge companies may also be there. They may not be able to commence the production, so we have given them one more year. So this date has been extended till 31st March 24. Under section 115 BBD, taxes from a dividend from a foreign company, foreign subsidiary company, are taxable at a subsidized rate of 15%. Meaning thereby that if an Indian company has a foreign subsidiary company in which they hold at least 20%, 26% shares, and the foreign subsidiary company gives them a dividend during the year, that dividend is brought into India, it was taxed only at 15%. Now the government says we want to bring in parity in the taxation of dividend, therefore we will put a sunset clause to this provision. So now all dividends will be taxable at the normal rates of tax. Now friends, talking about one of the other major discussed amendment regarding filing of updated returns. This is also a new step in this budget, a new concept which is introduced by section 139(8)(a) being put into the act. What is the need of an updated return? We already have provisions for filing of an original return. We can file a belated return. We can file a revised return. But still, it was felt that these are not sufficient. Now, the government took into account two aspects. One is they said that we want to trust the honest taxpayers. There could be circumstances where a taxpayer unintentionally, inadvertently, has forgotten to include certain items of income in the return filed by him. The government admits that the time for filing the revised return is too short. The revised return can at present be filed only till 31st of December. So you have hardly 5 months. In case of companies, only 3 months to file a revised return. Rather, in case of companies, only 2 months to file a revised return. On the second hand, the government has a lot of data regarding the financial transactions of the assessees. They are collecting this data from various sources. Earlier, the government used to keep this data secretly with them, and if the assessee does not disclose it, then they would charge him, issue a notice under 148, charge extra tax, interest, penalty, etc. Now the government is providing all that information to the assessee only. From last year, you would have seen that along with Form 26AS, you also get an annual information statement. This annual information statement contains a lot of data about the financial transactions of the assessee. You have data regarding whatever shares you had purchased, whatever FDs you are made, whatever house you purchased, whatever interest you have earned, even on your saving bank account, even transactions on which there is no TDS. Those transactions are also captured in the annual information statement. It could be possible that at the time of filing his statement, the assessee was not aware of these transactions. He did not go through these statements. Therefore, the government wanted to give another chance to these honest taxpayers. So now we have introduced this concept of an updated return. This provision says that if you want to declare any extra income which was not included in the original return, you can do that by filing an updated return within 2 years of the end of the relevant assessment year. So if I'm talking about assessment year 21-22, I've already filed the return. Till March 24, I can file the updated. While filing the updated return, I have to pay the additional tax on the additional income, plus I have to pay some extra tax also. If I file the updated return within a period of 1 year of the end of the relevant assessment year, additional tax is 25%. If I file it after 1 year, before 2 years, I will have to pay extra tax of 50%. This is extra tax which I have to pay 25% or 50% of the tax plus interest which is due on the additional income. Of course, I will claim the credit of all TDS, all advance tax, all self-assessment tax, all relief that I can claim under 1991, MAT credit, etc. All that will be allowed to me. Whatever extra tax is to be deposited, that must be paid before the filing of the return. Otherwise, the return will be taken as defective. So these are the provisions regarding updated return. Although it enables the assessee to file an updated return within 2 years, but we have a lot of exclusions also. A lot of people have been debarred from filing an updated return. Firstly, you cannot file a return of loss as an updated return. Here, the purpose is that wherever some income has been left out, you can include that provided you are paying an extra tax. So you cannot file a loss return as an updated. You cannot file a updated return to enhance your losses or to enhance your refund or to claim a refund. So updated return can be filed only when you are willing to pay more tax on the income which was not disclosed earlier. You cannot file an updated return if your assessment has already been completed or assessment proceedings have already been initiated against you. Whether these are proceedings under 143.3, 144, 147, or under section 153A, etc., whatever proceedings, if the assessment proceedings have already started, you cannot file an updated return. You cannot file an updated return if any prosecution has been lodged against you, any information has been received against the assessee under section 90A, that is information from foreign sources. If the assessee is covered under the Black Money Act, under the Benami Property Act, under the Coffee Posa Act, under the Smugglers Act, etc. So all those, as usual, they have been excluded. So primarily what the government wants is only honest taxpayers who have not committed any other defaults. If they are willing to come forward, they may pay the extra tax and file their updated returns. Then friends, amendments in section 148. Again, very crucial amendment. Last year, the finance minister deleted the old provisions of section 148 and inserted the new provision. Consequently, we also deleted provisions of section 153A, B and C, which dealt with assessment of search cases. The assessment of search cases was also merged with section 140. Now those assessments would also be undertaken under the new section 140. When the old provisions of section 148 were deleted, the government still issued a notification that notices under the old provisions could still be issued till 30th of June 21. Now that again created a lot of confusion. We had a plenty of notices being issued. These notices issued after 31st of March 21 were challenged in various high courts. Writs were filed in the Delhi High Court, Mumbai High Court, Jaipur. In fact, all high courts had writs seeking to quash these notices. And we already have judgments from at least 6 or 7 high courts, including Delhi High Court, Mumbai High Court, Allahabad High Court, Jaipur High Court, which have struck down these notices. On the ground that firstly, there cannot be two provisions of law operating at the same time. The old provision 148 and 148 new provision. Secondly, the notices which have been issued after 1st of April did not comply with the requirements of section 148A, which was inserted with effect from 1st of April 21. So these notices were quashed. We were expecting some retrospective amendment to give validity to these notices. Fortunately, we did not find any such thing in this budget. The government chose the other path. They have filed a SLP before the Supreme Court, challenging the orders of the High Court where these notices were quashed. So we will wait and see what is the fate of the SLP filed before the Supreme Court. Now, when the new provision of section 148, 148A, 149 was introduced last year, there were a lot of drafting errors in those provisions. In fact, we were very happy when we saw the new provisions because there the scope of section 148 had been reduced considerably. The new section 148 said that an assessment can be reopened, notice for reopening of the assessment can be issued only when the assessing officer has information which suggests that income has escaped assessment. Information which suggests that income has escaped assessment was also defined. There were only two circumstances mentioned. One, the information is flagged off by the risk management strategy. So under the risk management strategy, if any information has been flagged out, that could be used for considering that income escaping assessment. Secondly, it is raised as a final objection under any audit of the Controller General of India. So only two limited cases were there where income could be deemed to have escaped assessment. So only if it is flagged out by the risk management strategy or it is a part of the audit objections of the CAG. Then there was a proviso to there was an explanation to section 148 which said that in case a search has been conducted, it shall be deemed that the assessing officer has information suggesting escapement for 3 years prior to the year of search. That means only 3 years there was information, so they could not go beyond those 3 years. So these were some points which were there in the newly drafted section 140. The government realized the mistake, so therefore in this budget they have revamped section 140. Now what has been provided is that information which suggests that there is escapement of income could include any information from the risk management strategy. They have deleted the word flagged off. So any information received under the risk management strategy can be information. Any information under any audit, not only CAG, any audit, that will constitute information. Information received under section 1990A, that is information under DTA, etc., that will be included. Information collected in the new scheme framed under section 135A, which is the faceless collection of information. All that information will be included here. Any information emanating from the order of the tribunal or high court or any judicial authority which suggests that income of any year has escaped assessment. So they have broad-based that provision. In the explanation also relating to search and seizure, they have omitted the reference to 3 years, meaning thereby that if a search and seizure has taken place, the assessing officer shall deem to have information in his possession for all the preceding year. That was the changes brought out in section 148 to broad base that provision now. 148A was introduced last year to provide safeguards for the benefit of the assessee. Under those provisions of 148A, the assessing officer had to seek approval of the higher authorities at 3 stages. One, where he received the information and wanted to scrutinize that information, he could do that with the approval of the higher authority. He had to issue the notice, show cause notice to the assessee. He could do that with the approval of the higher authorities. He would get the reply of the assessee. Then he has to make up his mind whether he has to issue notice under 148 or not. That also he could issue the notice only with the approval of the higher authority. So at 3 stages, it was provided that approval shall have to be obtained. Now that again was found to be very cumbersome. So now we have done away with 2 approvals. Now wherever the assessing officer obtains the information, issues a so-called notice to the assessee, receives the information from him, and then wants to issue notice, only at this stage he will seek the approval from the higher authority. Thirdly, under section 149, 149 deals with the years for which reassessment notices can be issued. Reassessment notices can generally be issued for 3 years prior to the relevant year. For 3 years, there is no limit of the income which is escaping assessment. It could be 2 lakhs, it could be 50 lakhs, it could be 1 crore, or any amount. If the assessing officer wants to reopen any assessment for more than 3 years, then the condition stipulated was that there must be an income escaping assessment of at least 50 lakhs for that year, which is represented by an asset. So here again the scope had been limited. So if I had purchased a house 8 years back for, let us say, 70 lakh rupees, and the department has information that this 70 lakhs was out of undisclosed income, they could reopen my assessment because it is represented by an asset, that is my house. But what would happen if 7 years back I had spent 70 lakh rupees on the marriage in the family out of my undisclosed income? They could not take any action because it is not represented by an asset. So now we have again amended section 149 to include 3 things. Any assessment can be reopened beyond 3 years up to 10 assessment years, provided the income escaping assessment is at least 50 lakhs, it is represented either by an asset or expenditure or any entries in the books of account. Therefore, now even loans, advances, share application money, all that will be included, and assessments can be reopened up to 10 years provided the income for each year is more than 50 lakh rupees. And another safeguard has been put in here, just like we had under section 153D, which was abolished last year. Before finalizing any assessment under section 148 for reopening of where the assessment was reopened, that reassessment order has to be first approved by the additional commissioner. So before passing that order, the assessing officer will seek approval from the assessing officer, then only that order can be passed. So these were the amendments which were made in section 148, etc., which again will have a far-reaching effect. Now, if I come to the TDS provisions, there are 3-4 amendments, relevant amendments in various sections of TDS. We had section 206 AB and 206 CCA, which provided for TDS at a higher rate of tax in case of non-filers of returns. So if an assessee is a non-filer, the TDS rate would be double the normal rate. Who was a non-filer? Non-filer was described as a person who has not filed the returns for 2 assessment years prior to the relevant year. So if you did not file the return for 2 consecutive assessment years prior to the relevant year, your TDS rate would be double. Now we have reduced that period of 2 years to 1 year. So therefore, even if you have not filed the return for 1 preceding year, you will be treated as a non-filer. So now non-filers number will increase. All those who did not file the return for the relevant preceding year will be treated as a non-filer, and the rate of tax will become double in their case. We have made an amendment in section 194 IA. 194 IA provides for TDS in case of sale of immovable property. Wherever there is a transaction for sale of an immovable property, the buyer of the property has to deduct tax at the rate of 1% on the payment made to the seller. So whatever payments are made to the seller, 1% TDS has to be deducted, provided the total sale consideration of that property is more than 50 lakh rupees. At present, the consideration which was being taken into account, the amount of TDS was on the actual amount of consideration. There was no reference to the stamp duty value. While as if you come to section 43CA or you study section 50C, there the sale consideration is deemed to be the actual sale consideration or the stamp duty value, whichever is higher. This concept of the stamp duty value was not captured in 194 IA. So now we have amended that provision. Now the provision says there will be a TDS of 1% on the actual amount of consideration or on the stamp duty value, whichever is higher. So if my actual consideration is, let us say, 70 lakhs, my stamp duty value is 80 lakhs, I will have to deduct TDS on 80 lakhs. A problem will arise here. If when I see section 50CA, there a cushion of 10% is allowed. So only when my stamp duty value is more than 110% of my actual sale consideration, only then I take the stamp duty value to the actual sale consideration. If it is within 10%, my actual consideration prevails. For example, if my actual consideration is 60 lakhs, stamp duty value is 64 lakhs, 50C says take the sale consideration as 60 lakhs. Now what is 194 IA saying? It says stamp duty value or actual price, whichever is higher. So therefore I'll have to deduct tax on 64 lakhs. When I deduct tax on 64 lakhs, my sale concession in 26 years will be reflected at 64 lakhs. I will declare 64 lakhs as the sale concession. Again, there will be a mismatch. Again, the assessee will have to go through the triggers of either assessment or rectification, etc. So those problems will again arise. There will be so many other complications also. For example, under section 50C, the provision says that if the date of agreement and date of sale are different and the assessee has paid some consideration at the time of agreement by way of check, then the stamp duty value on the date of agreement should be taken. We don't have such provision in 194 IA. So although we have introduced this concept of the circle rate, of the stamp duty rate, but still some problems will arise which need to be addressed by the government. So in the post-budget memorandum being prepared by the Institute, I would suggest that these things are also taken care of. Two new sections have been introduced, 194R and 194S. 194S we have already discussed under digital assets. 194R is also an important section which has been recently introduced, which provides for a TDS on the benefits or perquisites provided to a person in the course of carrying on a business or a profession. Now, if a person is carrying on a business or a profession and during that course he receives certain benefit or perquisites, those are also deemed to be his income as per section 28 clause 4. Right? For example, a company manufacturing cement appoints a distributor, pays a commission of maybe 1 crore rupee to the distributor based upon the percentage of sales attained by him. They also say that if you achieve a certain target, maybe sale of 50 crore rupees, we will give you a free tour to Switzerland. Now a distributor who attains this target gets a free tour which costs, let us say, 8 lakh rupees to the company. Now what is the treatment of this value of 8 lakhs in the hands of the distributor? 28.4 says this will be treated as your income from business. Similarly, a person carrying on a profession, let us say a chartered accountant, he works for a client, the client pays him the fees and also provides him office space which he is allowed to use for any purpose. Not only this client, he can use it for even the assignments of other clients. No rent is charged by him. That is also a perquisite. So the value of that is also to be taxed in the hands of the professional. Although we have section 28 clause 4 in place, but the question was how many people were including this amount in their return? What was the reporting mechanism? Right? We found that large number of people who were enjoying these benefits did not include that while calculating their taxable income. So now we have introduced a provision whereby a liability is cast upon the company, upon the person providing this facility or giving this benefit to deduct tax at the rate of 10%. So the company providing the facility, providing the perquisite will deduct tax at the rate of 10% if the amount or the value of the facility exceeds rupees 20,000. So when there is a liability to deduct tax, then there will be a lot of reporting. Because if this company does not deduct the tax, then 40A IA will also become attractive, meaning thereby that if there is no TDS, 30% of the expense will be disallowed to the company. So therefore, the companies will now start deducting tax at the rate of 10%. This will encourage collection of tax as well as there will be a reporting mechanism. So now this income will not be escaping. These were the amendments regarding the TDS. We have a small change in the provision regarding repetitive appeals. A new section 158 AB has been introduced. Earlier also we had a provision with section 158, 158A, where in the case of the assessee himself, if certain matter was pending already in appeal and there was an occasion to file an appeal for another assessment year on the same ground, the department would not file the appeal if the assessee would say that he will be bound by the judgment in the earlier assessment. Now we have expanded that provision. Now this provision says that if any appeal on a matter of law is pending before the High Court or the Supreme Court in any matter, whether of the assessee or any other person also, if the matter is pending before the High Court or the Supreme Court, and the Income Tax Department through a collegium of commissioners consisting of at least 2 commissioners, with the consent of the assessee, decides that a matter is similar to the pending matter, they may not file an appeal for the SSC, provided, as I said, the SSC agrees to be bound by the judgment of the High Court or the Supreme Court in the other matter. To illustrate, supposing the matter of Mr. Ram for a particular year is pending before the High Court. The same law point arises in the case of Mr. Shyam. The department will give an option to Mr. Shyam. Either we file an appeal in your case also, or if you want, we will not file an appeal. If you give a consent, that you will be bound by the judgment in case of Mr. Ram. So in that case, you can prevent the multiplicity of the appeals being filed. Then friends, some amendments regarding penalties which are imposed. Two or three amendments which need to be discussed. At present, penalties are imposed under section 271A, 271 AAB, AAC, AAD. These are three new provisions inserted in the preceding few years. Under section 271 AAB, penalties imposed in case of search assessments. It is 30% of the undisclosed income on undisclosed tax or 60%. If the undisclosed income is included in the return of income filed, the penalty is 30%. Otherwise, the penalty is 60%. Under section 271 AAC, there is a penalty of 10% wherever any tax has been imposed under section 115 BBE. 115 BBE already provides for a tax to be charged at the rate of 78%. Therefore, the rate of penalty is only 10% in that case, if that amount is not included in the return of income. Under section 271 AAD, which was introduced recently, there is a penalty of 100% in case of falsification of accounts, issue of false billing, issue of bogus billings, bogus entries in the books of accounts. So all these are covered under 271 AD, where we have a penalty of 100%. The question was, who will impose this penalty? At present, the penalties can be imposed only by the assessing officer. Generally, under the old provisions, we used to give that power to the Commissioner Appeals also. Because when the appeals are filed before the Commissioner Appeals, in some cases, he might enhance the assessment. He has the power of enhancement. So if an income is enhanced, then who will impose the penalty on the enhanced income? Because that was not assessed by the income tax officer, by the assessing officer, he cannot charge a penalty on that. So now we have introduced the enabling provision. The Commissioner Appeals has also been given a power to impose a penalty under section 271 AAB, AAC as well as 271 AA. Right? This amendment has been made retrospectively again from 1/4/22, assessment year 22/23. Penalty imposed under section 272A, which at present is 100 rupees per day for small offences like not providing information in time, etc. That was considered too small a deterrent, so 100 rupees has been increased to 500 rupees. Some welcome amendments with regard to business reorganization. Here we cover cases of amalgamation of companies, merger of companies, or even demerger of companies. In these cases of reorganization, there was some very technical issues, some very important problems which were being faced. One of the cases was, whenever there is an amalgamation of the companies, what is the procedure that we follow? We make a scheme, we draft a scheme of amalgamation. We also lay down what is the appointed date. that is from which date will the merger or the demerger will be effective. We present this application to the competent authority. Earlier it was the High Court. Now we go to the NCLT. The NCLT may take 6 months, 1 year, 2 years to pass the order. Now supposing the order is passed after 2 years, but it always becomes effective from the appointed date mentioned in the scheme, unless and until that appointed date is changed. Now in between this period, the appointed date is earlier, date of order is later. What does the assessing officer do? He keeps on making assessments on the predecessor company also, because that company was not striked off. It's continued to exist till the final order is obtained. We had very large number of cases, including the judgment from the Supreme Court, which said that any assessment made upon a non-existent entity will not survive. So ultimately, when the order of the NCLT comes, the predecessor company does not exist. So these assessments were held to be invalid, were non-existent. So therefore, there was a lot of loss of revenue because of these interpretations. So now it has been clarified that any assessment made on the predecessor company in a scheme of reorganization shall be deemed to be an assessment on the successor company. So therefore, the successor company shall now become liable to pay the taxes in all these cases. Secondly, whenever a merger takes place, you are required to consolidate the accounts from the effective date, and from that year onwards, all the accounts, from that date onwards, the accounts need to be merged. Right? Because now we have one entity instead of the two entities. X company has already merged with Y company, so only Y company exists, X company goes out of existence. So the accounts of X company also have to be merged with the accounts of Y company. But this would happen only after the merger order has been obtained. But that time, the time to file the revised return for the two companies is already expired. So how would I file the return for that? So we have introduced now another type of return, which is called a modified return. So we had the original return, we had the revised return, we had a belated return, we introduced the updated return, we have now introduced what is called a modified return. So whenever the order of the reorganization, the merger, amalgamation is received, the successor company will file a modified return taking into account the merged accounts of the predecessor and the successor company. So these were necessary amendments which had to be made in order to provide for them. So we have section 172A and 170A which have been introduced. Another problem that was arising was regarding the demand outstanding in cases where the companies had gone to the insolvency or bankruptcy board. Whenever these companies approach these boards, they have the power to reduce the liability of the company. That liability may be reduced, maybe entirely, may be reduced by 50%, may be reduced to 25%, depending on the circumstances. When these companies would go with this order to the assessing officer did not have any power to reduce the tax demand. They could reduce the tax demand on the basis of an order from the Commissioner of Appeals, the Tribunal, the High Court, etc. But they could not reduce the demand on the basis of the order of the Insolvency Board or the Board for Bankruptcy, etc. So that power has now been given to the assessing officer under section 156A. So wherever there is an order for reduction of the tax liability, that effect will be given by the assessing officer under 156A. A small correction in the drafting in section 179, which existed for a long number of years. 179 provides for recovery of the tax liability of a closely held company from the directors of the company. So if any tax liability of a private limited company could not be recovered from the company itself, there is a provision that in certain circumstances it can be recovered from the director. However, the heading of this section provided that recovery of the tax from the directors in case of liquidation of a company. Whereas the body of the order did not talk about liquidation, it talked about all circumstances. So therefore, that error has now been corrected. It says now recovery of the tax of the company, of closely held company from its directors. So in case of liquidation, that has been omitted from the heading of the section. I think these were the major amendments. These were the important amendments that needed to be discussed. Now I will come to the amendments which have been made with relation to the charitable trust and organization. A large number of changes have been made in these provisions. In fact, when I was going through the memorandum explaining the amendments, I found that there are 22 pages devoted to these amendments pertaining to charitable trust, etc. I have tried to summarize those amendments, the important amendments I am going to discuss with you. Friends, at present we have two regimes for granting exemptions to charitable institutions. One regime is under section 1023C, the other regime is under section 11, 12 and 13. There used to be a lot of anomalies in these two provisions. We have been trying to harmonize the provisions over the last years. A lot of effort has been made in that, a lot of changes have been made in the preceding years. This year, some more amendments have been made in order to harmonize these two provisions. Under section 1023C, there are various clauses. Clause 1, 2, clause 3, etc. deal with some government organizations, government funds, like the Prime Minister's National Relief Fund, etc., whose income is exempt. There are no changes in that. We are talking about clauses 4, 5, 6 and 6A to section 1023C. Clause 4 talks about notified charitable institutions. Then we have notified religious institutions. 6 talks about charitable universities and educational institutions having turnover exceeding 5 crore rupees. 6A talks about hospitals and other medical institutions having turnover exceeding 5 crore. The income of these institutions, organizations is exempt from tax provided they are notified, they are approved by the specified authority. Specified authority was not clarified in the Act. Now it has been said that in all cases, the approval to these institutions shall be granted by the Principal Commissioner. That was one amendment that has been made in 1023C. Then, under both the regimes of 1023C and Section 11, we found that a lot of charitable organizations or religious trusts are receiving donations for protection of various monuments, religious places, etc. So a trust receives a donation to maintain a gurdwara or a mosque or a place of national importance. Donations are received for this purpose, but there was no specific requirement that you to apply the donation for this purpose only. You could apply it for any other purpose also. Now we have made a clarificatory amendment that these donations will be treated as corpus donation and have to be applied for the purpose for which they were received. Till the time that they are not utilized for that purpose, they have to be kept invested in the mode specified under section 11.5. So the treatment will be the same as in the case of corpus donations. Friends, again under the second regime, we have section 11.2, which allows the charitable trust or the religious trust to accumulate their income for a period of 5 years if they are not able to apply 85% of their income during the year. Right? In order to claim the exemption, the trust is required to apply 85% of its income during the year, or they can accumulate the income by filing a declaration in Form 10 before the date of filing the return that we want to accumulate this income, and the maximum period for which they can accumulate is 5 years. So the accumulated amount has to be utilized within the period of 5 years. If it is not utilized within the next 5 years, it is deemed to be the income of the 6th year. We have now changed that provision, and it shall now be deemed to be the income of the 5th year itself. So we will not wait to tax it in the 6th year. If you do not utilize it within 5 years, it will be deemed to be the income of the 5th year. There was no corresponding provision to 11.2 in section 1023C for accumulation of the income. So we have inserted explanation 3, 4 and 5 under section 1023C also to enable those trusts to accumulate the income for 5 years, to utilize it within 5 years, keep the funds invested in 11.5. If they do not utilize within 5 years, it will be deemed to be the income of the 5th year. So parallel provisions now exist under section 1023C as well as under section 11. Under 1023, under section 11, the regime under section 11, we had a provision that exemption will be allowed only if they file the return of income under section 139(4)(c) within the time prescribed. If the trust, etc. under section 11 do not file the return, they will not get the benefit of the exemption. This provision did not exist under 1023C. It has been made applicable there also. Then under both the regimes, we had a provision for audit of the accounts. If the receipts of the trust exceeded the maximum not chargeable to tax, the trust or the institution would have to get their accounts audited and submit the audit report in form number 10B. All audit reports, as we know, have to be filed 1 month before the due date of filing the return. Although there was a provision for filing of the audit report, there is no provision at present for maintaining any books of account. So the trusts claiming exemption, many of them were not maintaining regular books of account. They would just keep their record of transactions in a form of a diary, in the form of a notebook, etc. And the auditor would have to audit on the basis of those transactions. Now we have amended the provisions under both the regimes, and it has now been made mandatory for all these trusts and institutions to maintain the specified books of account. If they do not maintain the books of accounts, again there will be a violation and the exemption can be denied to them. If the trust misutilizes the income of the trust has to be utilized only for the benefit of the public. That is why we call them public charitable trust, public religious trust. There is a specific bar under section 13 which says that any portion of the income or the assets cannot be used for the benefit of certain vulnerable persons, certain specified persons. These specified persons would include the trustees, the settler, the substantial contributor to the trust, their relatives, etc. If you spend any amount for their benefit, that portion will be deemed to have been misapplied. So it is not applied for the purpose of the trust. That portion will not be allowed as an exemption. That was not considered to be a deterrent enough. What we have done is we have inserted a penalty under section 271 AAE, which now says that if any amount of the income, any portion of the income of the trust is utilized for the benefit of these persons, the trust shall become liable to pay a penalty of 100% of that amount. It will be disallowed, that is one case. Secondly, penalty of 100% of that amount will be levied. Further, if such a default is committed in a subsequent year also, the penalty will be double this amount. So 200% penalty will be imposed upon the trust. This is a similar provision again in both the regimes. Then there used to be a dispute regarding what is the meaning of the term applied. The trust has to apply 85% of its income. What do I mean by applied? Certain judicial pronouncements said that even if a trust has incurred an expenditure, not made a payment for that, still they have deemed to have applied that income. For example, an hospital ordered for 100 beds, the beds have been delivered, the bill has been delivered to the hospital, bill has been raised and delivered, but payment has not yet been made in this year. Can I say that the income has been applied? According to judicial pronouncements, yes. They said that if it has been incurred, it is applied. That again was not the intent of the legislature. They said that we will deem it to be applied only when the amount has been actually paid. So that amendment has been made. We have inserted an explanation 3 to section 1023C, and correspondingly an explanation has been added to section 11, where it has been clarified that applied will be only when the amount has been actually paid. Then we had introduced a few years back a new chapter called chapter 12ED, consisting of sections 115TD, TE and TF. These were to cover those cases where a charitable trust ceases to be charitable, or it merges with an organization which is non-charitable, with a commercial organization. In Delhi also we saw a lot of cases where certain charitable hospitals which had obtained land from the government on concessional rate built a hospital by collecting donations, built their infrastructure through the donations. They did not pay the tax by claiming exemption under section 11, etc. Subsequently, these were sold to commercial organizations. We had no provision whereby we could tax or withdraw the exemptions which have been enjoyed by them. So then 115TD was introduced, which provided that if this trust ceases to be charitable or it merges with an organization which is non-charitable.
Sir, your video is not visible.
My
video is not visible.
video is not visible. Video is on. My video is on.
I am unable to see actually. Yes, now it's visible.
Okay. So we introduced section 115TD to provide that as soon as this trust ceases to be charitable or merges with an organization which is not charitable, the market value of the assets of the trust shall be deemed to be the income of the trust. So even if they have acquired the assets for, let us say, 2 lakh rupees, market value is today 2 crore rupees, 2 crore rupees shall be deemed to be their income, on which they will have to pay the tax. These provisions were inserted only under section 11, 12 and 13. Corresponding provisions were not there in case of section 1023C. So under the first regime, there was no taxability still. So now we have introduced explanations in that section also. I think it is the 30th explanation which has been inserted, and now these provisions will apply to 1023C trusts also. So I think these are the major amendments which have been made to charitable trusts also. There might be some small amendments more than this, but I think this is what we need to know at the time. So friends, I have tried to cover all the major amendments made in the Finance Bill 2022, and I now hand over the session to the session chairman, the moderator, for any question answers that we may have from the audience. The participants, if they have any questions or if there are any questions in the chat box, we can take up those questions. Over to the moderator.
Sir, I have WhatsApp the questions to you. If you want, I can read it for you.
If you could read it out, it will be easier.
Yeah, sure, sir. First question is, no, it's related to GST. So, will this budget lead to slightly inflationary situation on account of capital infra expenditure?
Uh, See, that is from an economic viewpoint, you are analyzing the budget. In the budget, there is a huge emphasis on the expenditure on infrastructure and development of infrastructure. Development of infrastructure will lead to definitely increase in employment, creation of more resources. If you say that it will have an inflationary effect, yes, to a certain extent, yes, because the expenditure of the government will lead to more money in the pockets of the general public. That might be inflationary in nature, but a little bit of inflation up to a certain extent is good for any economy. It leads to increase in demand, increase in production, and growth of the economy. So even if it is a little bit inflationary, it shall be for the betterment of the economy.
The next is whether demerger will come under slum sale under new definition.
No, no, no. See, in case of a slum sale, in case of undertakings, there is a consideration being paid. In case of mergers, amalgamations, there is no cash consideration. Consideration is only in the terms of exchange of shares. So mergers, demergers will not come under slum sale.
Okay, just a second, sir. So next is, what is the amendment in personal liability of taxes of directors of companies?
There is no change there. On the question of recovery of the tax due from a closely held company from the director, there was only a drafting error that has been rectified. The liability remains the same. In case of tax liability, only in cases of closely held companies, if the company is not able to pay, the amount may be recoverable from the director. But if the director is able to establish that the non-recovery of the tax of the company is not because of his negligence, then you cannot recover the tax from the director.
Is
So
this
the liability of a director with respect to tax liability of the company is very limited.
Okay, sir. Is this COVID treatment reimbursement from the firm is available for a partner of the firm?
Maybe under 56(2)(10), yes. Because it is not a perquisite covered under section 17, but yes, it can be covered under 56(2)(10). So it will be exempt.
If trust files return by due date but 10 be filed with return and not within due date, that is 1 month earlier, can entire expense be disallowed and trust to pay tax on receipts?
No, the trust will have to pay a penalty, which I think is 100 rupees per day at present, for delay in filing of the audit report.
Okay.
In that case, the entire amount of exemption will not be withdrawn.
Please give some example for which TDS under section 194R is to be made, whether sample to customers both in pharma and other manufacturing companies will come under 194R.
No, no, no. See, 194R is meant to cover the benefits or the perquisites received by a person in the course of carrying on of his business. So when, let us say, a company is distributing certain samples to the doctors, does the doctor get a personal benefit out of that? Extreme case could be that he sells the sample. if he sells the samples, that would be an illegal activity that the company has not given him the sample to sell. So company does not provide him with a benefit or a perquisite. If the company provides, let us say, or gives a car to the doctor, that would be covered here. The value of the car would be a benefit to the doctor. There it will be covered. On the value of the car, the company would have to deduct the tax. If they are giving it in kind, then they will have to ensure that this amount of 10% is deposited by the doctor before the asset is released to him. Just like we have the provisions in case of a lottery income. Supposing a person wins a BMW car in a lottery, the person who is giving that amount, giving that car, has to ensure that the winner deposits 30% tax before the car is released to him. So wherever the benefit is given in kind, the giver will ensure that the tax is deposited. If the amount is given in cash, he will deduct it at the source.
Can we
So,
file
yes, next question, please.
can we file updated return in case of decrease of refund?
Mm, decrease in refund if it is because of addition in some income. If you are declaring an additional income and there's a decrease in the refund, yes, you may file the updated.
So that's it. No more questions are there. But sir is joining in a minute, so I am just calling him that he may join. Hello? Hello?
Yes.
Yes, sir. I'm just calling Chairman sir because he told me that he will join. So I'm just calling him to confirm. Just a
Okay.
minute, sir.
Okay. Okay. Chitla sir is to join?
Yes, sir.
Okay. Just see if it is if he is there.
So he's not picking up the call actually.
Okay. Okay. Never mind. We can just inform him.
Yes, sir. So thanks a lot, sir, for the wonderful session. And you have covered almost all the amendments which are there in the union budget. So thank you for today's session.
Thank you, ma'am. Thank you. It was a pleasure being here, especially with the Direct Tax Committee. I have been a part of this committee in the preceding years. So it is a pleasure for me to be a part of this proceeding. Thank you so much.
Thank you, sir.
Thank you.